October 11th, 2023. I made the point the other day that when you get a correction of a rally, it's generally going to be about half the amount of bars of the rally. That's, what you're usually going to get. And you can see here, a lot of traders would argue that the rally started here, which I think makes sense. And it went up to here for the signal bar, and that's 193 bars. So give or take, 90-ish, 95 bars there should be for the correction. And you can see it ended up being about 92 bars. So again, usually when you get a rally, if you're going to get a second leg, the correction is going to be about half the amount of the rally. And you can see we got a rally, a correction, and then we started the second leg this afternoon. Additionally, we tried to get a wedge on the open trade. This was, essentially it's 1 pullback, 2 pullback, 3, and then a 4th push down. So traders trying to force some sort of rally in here. And they might have been able to if this bar hadn't been so big. If it's a smaller bar, traders will probably buy above it. But it being so big made less traders willing to buy. And so when we ended up getting the reversal down, a lot of traders might sell below 21, hoping that we're going to get a measured move down here, which is essentially, if you think about it, the bull flag. So you're getting, an attempt at a wedge, and then you get a measured move down of the bull flag, which was the attempt at the wedge. I have a couple other failed wedge opens. Not many, but just a couple. This was today. This was, all the dates will be up here. But you can see here, we attempted to get a wedge on essentially bar 10, bar 16, and it failed. We got a measured move down to here. And this day, we tried to get a wedge down, it failed. We got a measured move up. And on this day, you can see this one's a bit protracted, but this was essentially one wedge attempt that led to a measured move down. And then you could say 1 pullback, 2 pullback, 3, and another attempt at a wedge, and it failed, and you get a measured move down right where 46 reversed. So this is a pretty common pattern. Whenever you get an attempt at like a wedge or something, you need to be thinking about what's it going to look like if this succeeds and what's it going to look like if it fails. So when this starts to rally, you got to think, well, if this is going to go, it's probably just going to go, right? If you're buying above 18, you're not looking for bad follow through like 19. So a lot of traders, what they'll do is they'll have a stop to exit 1 tick. So let's say they bought above 18, they'll have a stop to exit 1 tick below 19, and then you get 20, stop to exit 1 tick below 20, knowing that if we trade below another bar, their premise of this is a bull trend probably isn't valid. And so a lot of those traders will exit right below 20, which is what causes 21. And 21 is a reasonable swing trade since there's a 90% chance that we're going to break out of the opening 18 bar range. So 90% chance we're either getting here or here today, and it's more likely we're going to get down here currently because we're closer. So a lot of traders would sell below 21, betting that we're going to end up breaking out of the 18 bar range and potentially go for a measured move down of the wedge. We got a big bull bar on bar 1 and bad follow through on bar 2. When you get, bad follow through is extremely common on the open. Something else to keep in mind is that the opening range was pretty small. A lot of times when you get a really small opening range, it can lead to a trend day in either direction. Like yesterday, opening range really, really small. We got a trend. Today, opening range really small, and we got a trend, and we got a big reversal. We did have a big reversal yesterday as well, too, though. So not surprising there are buyers below 2, and there are probably sellers above 3 because it's a bear bar. And so we get buyers below 2 during 3 and sellers above 3 during 4, just very sideways. And then you get a big bear surprise on bar 5. Now, once you get bar 5, you automatically need to be thinking about the limit order bulls, right? So the bulls who bought below 4 and the bulls who bought below 1, are they going to be able to make money? You get a reversal bar on 6, and some would argue, the bull argument is, the gap is a bull bar and follow through on 1. And it's a 2-legged correction and a buy above 6, but it's probably not that good of a buy considering how small the bar is compared to this. But bears know that a lot of always in bears who are short for any reason or maybe sold to close of 5 are going to be disappointed in 6, and they might start to exit above, and that might cause a rally back down to the 1 low or the 4 low. Bear bar on 7, another push down. Some art traders would argue it's 1, 2, 3. So it's essentially trying to form some sort of wedge here. And, 7 doesn't close that strong, so it's disappointing for the bears. So that's why a lot of them are buying back shorts, which is what's causing 8. But bears also know that there are probably more sellers than buyers above 7. So traders will sell above 7, trying to keep the gap open with the 1 low. And the 4 low, traders, it's a trading range day. So generally traders who, buy below things and sell above things are going to make money. And you can see they got very close to getting out during 19, but not quite able to until late in the day. But when you see 8, and I think it's really noticeable that we were not able to get back to this 1 low. I think that's really important. and you ended up getting a big bear bar closing your low on 9. So you have a wedge down, and you're probably going to get some sort of attempt up, but this is a pretty tight channel from 2 to 9. So expect a second leg and then maybe an attempt up. And you can see 9 big bear bar, but it's a third push down in what's probably a trading range. So not surprising you get bad follow through on 10 or 11. Additionally, you're around yesterday's close. If you sold below 9, think about how disappointed you are in 10. And so it's not surprising that when those traders get back, down here and get a chance to exit at break even, they take it really quickly, and that causes the rally on 11. 12, bull bar, probably buyers below 11 since we're a couple pushes down and it's buying below a bull bar. So not surprised there were buyers below there. 12 is maybe a reasonable swing buy, but the problem is this is a tight channel. It's potentially a wedge, but the bear channel is pretty tight. So that lowers the probability of the swing trade working. You get follow through on 13, but it's not what you want if you're taking that buy. If you bought above 12, you wanted to see a bar essentially like 17, a big bull bar racing up to the 4 low, because that's probably your profit target if you're buying above 12. I assume you get about 2 to 1, and it's probably about a 40% trade. So it's a reasonable trade. But 14 is not the follow through you want. You wanted a big bull bar. Why? Because it's a low probability trade. And when it's a low probability trade, you want big follow through. Kind of similar thing with 21. Look at the follow through 21 got on 22. That's the kind of follow through those traders are looking for. 14, buyers below 13, and we end up getting outside up. It's not surprising we found some sellers up here. There are a lot of tails, so it could be leg 1, pullback, leg 2. So this could be 2 legs up. Additionally, the traders who bought above 12, disappointed 13, are exiting around break even on 14, and that's causing a lot of the selling. Inside bar on 15, probably buyers below, probably sellers above. And then you get 16, again, probably buyers down here. And a big bull surprise on 17. If you got a bull reversal bar, let's say you got, something like this. Let's say you took this bar and you could put it right here as an inside bar. I think that would be a reasonable wedge and a reasonable swing trade, because you had this steep trend line and we broke the trend line, and this would be a second attempt up. And that's pretty much what you look for with major trend reversals, trend line break and reversal up. And it's early in the day's range. So, excuse me. So I thought it would be okay. But you can see a lot of traders front ran it, and that's what causes 17. And when you keep trying to look for bars to buy, but they're disappointing you, they're getting too big, they're just not quite right, you're probably in a trading range. And so on 18, you could buy above 18, but you know that the 4 low is going to be resistance. And so when you get a bear close on 19, a lot of those traders who bought for any reason up here are just getting out of break even during 20, and that's what causes the big tail on 20. And like I mentioned earlier, I think a lot of traders were using a really tight stop because we might end up getting a bull micro channel in a rally. The reality is if we trade below one of these bars, this can happen pretty quickly. And so you got to be really quick to get out below 21 or, below 20. And that's what's causing all this selling. If it's a spot where you think bulls have to get out, when you see 21, bulls probably have to get out, right? And if it's a spot where you see that, it's probably also a reasonable sell in the other direction. So like if you think bulls have to exit below here, well, you can sell below there because you'll have bulls selling as well. And if bulls and bears are selling, you'll have a better chance of making money. You get follow through on 22 to a new low, but you can see it gets bought up pretty quickly on 23. Additionally, something I wanted to go over before I forget to talk about it, I think this is cool. The 29 low here. So bulls buy below the 29 low because it's a bull bar and it's a reasonable thing to do. And you can see even on 32, they were never able to get out at break even. And later in the day, so if the bulls were trapped and they were never able to let out at break even, what should happen when we get to this price? There should be sellers when we get to this price. So it's reasonable to sell on a limit order at this low. And a lot of traders do that, but then you get a big bull surprise on 59. But these traders did something reasonable selling this low. And so what should happen is there should be a retest. And you can see that's exactly what 60 did. 60 came back and retested, it's the low or one tick below the low of 29, right where those bears got trapped, and they bought back shorts really quickly. And that's what caused, that's contributing to this rally. But I was talking about 23, 24, 25. They're all inside bars. When you get a sell climax and then an I pattern, so sell climax, inside, a lot of times you get a sharp reversal off of that. I have some examples, but I'm just not going to show them right now. But a lot of times when you do get an inside pattern. You'll get a sharp reversal off that. And we got an I today, which is pretty rare. I thought that was cool. We don't usually see 3 consecutive inside bars. But what this is telling you is the market's in a tight trading range, and there's a 50% chance of the first breakout down failing and a 50% chance of the breakout up failing. So you can see bears tried to break out to the downside. There were limit order traders buying right at this low because they bought at this low, bought more lower, made money. So they know they're going to be able to buy at this low and buy more lower if necessary and make money. And they didn't even have to that time. And you can see the traders bought, and we got a reversal up 29 and 30, but nothing was able to close on or near its high. So bulls made an attempt to reverse the market, but nothing was really ever able to close near its high. Generally on channel days, the counter trend entries are going to look better than the with trend entries. And the with trend entries are going to be harder to take, but they're going to be the ones that work. Like selling below 30 doesn't look all that great. We're probably going to get back to the 29 low, but it's an okay sell. You could look at it as a wedge pullback 23, 25, and 28, 29. So some traders will sell below 30 for a swing. Follow through on 31 for the bears, but not all that great. It's a trading range, so the follow through is going to be bad pretty often. And then you get 32. It's an outside up bar, but I think it's kind of the same problem that I was talking about over here, where the bars aren't quite good enough. It doesn't quite look good enough, and the context isn't quite good enough. I think if 32 closes on its high, you can maybe buy for a swing, hoping to get back up to here, this low, which is about where we end up stalling over here. But regardless, I think that, if it closes strong, you can probably buy for a swing, thinking that, this is some sort of final flag trading range, and, it's 1, 2, 3, or 1, 2, 3. So 3 pushes, some sort of nested wedge, but it doesn't close strong. And any bull who was front running this, limit order bulls buying down here, they might be buying down here, hoping that we're going to get a reversal up and they can buy more above the bull bar and hope to get a swing. But instead, they get a bad close, and so they just scalp out immediately with a small profit. And that's what causes the inside bar on 33. Which again, maybe an okay swing short, but it's just really hard to do that, because when you get follow through on 34 and 35, then what do you do on 36, right? It's a doji bar, and you could pretty easily get a rally that's going to at least test your break even price, which is what this does. And so it's just a really tough call. 39, it's a low 2. So bad follow through, bad follow through. Bad follow through. Traders seeing the bad follow through, exit at the market, causes a rally. Trades back below the low 1, triggers. There are probably buyers below 37 though, because it's a bull bar and we're towards the bottom of a bear channel. So we get the buyers outside up 38 and a low 2 short at 39. Not surprisingly, bad follow through on 40. You're going to get a lot of bad follow through in trading ranges, and then a big bear bar on 41 outside down, and then a big bull bar on 42. Technically, 42 triggers the buy above 41. 42 is an attempt at a midday reversal. I thought it was an okay swing buy. But this isn't really the follow through you want on 43. I think it's a reasonable buy. You are in a tight bear channel, but you get good buying pressure here, good bull bars. These aren't the best bull bars, but they're still decently big. And then you get this big bull bar. And, the big thing for me was limit order bulls were making money. The bulls who bought below 1, they scaled in lower and made money. And there were no real open gaps. And so, you buy below here, scale in, you make money. You buy below here, even you scale in, you make money. You buy below this, you're making money. So the big thing for me was limit order bulls had been making money all day. And I thought that eventually stop order bulls were going to start to make money. And, if you had bought above 36, it's not a good idea, but you were able to make a 1-to-1 pretty quickly. And so you could argue that some limit order bulls who bought above there made money. The important thing to note is just that this bear trend is not strong. That's all I'm really trying to get at with that point. And so bad follow through 43, and then you get 44. But the entry price for 44 is the same price that it is for 42. Generally, if the market gives you the same entry price at a later time, it's a little bit suspicious, especially if the market gives you a better entry price at a later time. You get this and then a pullback and another reversal up. You should be suspicious of that, because when you have more time, you have more information. The concept of swing trading is based on the fact that, when you're buying 53, you don't have a ton of information about, how far this bull trend could go, but you're kind of just taking a chance that we're going to rally. The same thing you're doing in here. And so if it's giving you more information at a better price, it's quote unquote too good to be true. So you have to be careful. Follow through on 45 is not ideal. It's a double bottom with 42, 44, and the neckline is 43. And so even after 45, you can see on 46, we failed to break above the neckline. Bulls really wanted 45 to close above the neckline, but we got a big failure and big outside down bar on 46. But what do you notice about 46? It's one of the best looking bear bars in this entire bear trend, and we're pretty oversold. I don't know. I'm just curious. There's probably some sort of leg one, leg two measured move in here somewhere. You could argue that's one. Maybe it's with the tails. I don't know. Yeah. So, there. So you could argue you're getting close to, some sort of leg two measured move, and it's a big two-legged correction from past couple days of rallying. It's important to keep the overall context in mind. So when you get this big of a bar, it's one of the biggest bear bars deep in the trend. It should make you think that we're probably actually going to go sideways, and this might be climactic. And when you're thinking that, you should be looking at the 45 low, thinking that we're probably going to get back to that low, and you should be looking for a reversal up. And so, that's when you start thinking about the magnets. Well, what about the 20 low? What about the 29 low? What about the 45 low? So you start thinking about those things and if we're going to be able to get to them. So 47, bad follow through for bears. 48, bad follow through for bears. It's a low one sell, but it's probably not that good. We're pretty oversold here. So when you get 49 and 50, bad follow through on 50, the bottom of a trading range, traders are going to start to take profits. 50, 51, 52. 52 is double bottom with 50. You can see that it's a final flag. Whenever you get, generally when you get a tight trading range deep in a trend, it turns into a final flag. This, for example, final flag of this bear trend, and we got a bounce. Bears tried to form a final flag here, and we tried to get the reversal, but the final flag failed and turned into a pullback, and we get the final flag here that ends up going. You get follow through on 53, and immediately when you get 53, you should be looking at this open gap right here and be wondering if the bears who sold above the high of 50 or 52 are going to be able to make money. And if they're not able to, and they start to get trapped like they do on 54 and 55, you should be thinking that we're probably going to end up rallying. I think it's interesting what happened over here. You get bad follow through on 56. And sometimes after this, you're just going to get a kind of a bigger bear bar, maybe something that looks like this, but it'll probably have a tail because bulls will buy the 50% correction. And if we get back to here, bears will realistically probably buy back their shorts at the market. So, but it's not unrealistic to think that we're going to pull back after 56. Because if you exit below 56, what you're saying is, I am scared of a bar like 41. I don't want to see that kind of bar here, which is fine. And so a lot of bulls will exit below 56, but then 57, it's an outside up bull bar. It doesn't close near its high, but it's still not this. So if you were long and you exited below here and you get not what you're scared of, you got to ask yourself, if I had sat through that pullback, would I still be long? And if the answer is yes, then you got to buy again at the market. That's the way to think about it. Is if you take a trade and you get shaken out of it pretty quickly, and then it starts to go your way, and you would still be, if you know how you would manage that trade if you were still in it, then it's okay to just put the trade back on. Because once you start to get 58, you can see traders just bought the market, right? They got 57. They said, oh, well, we didn't need to get out. And so they bought the close of 58. And, or they bought the close of 57. Some traders waited for follow through on 58 and they just bought. And that's what causes a big rally up in a vacuum test, essentially, of these highs and hopefully trying to get to this low on 59. Not surprisingly, since it's a trading range day, when you get a big bar, the risk becomes big, and oftentimes traders take partial profits. Stops can be moved up below here and below here. Probably buyers below 60, but occasionally, since it's a trading range, you'll get a sell-off. So traders know that always in bulls will exit below 60, which is the reason why it didn't trigger. I mentioned here that the traders who sold this low as we were rallying needed a chance to get out at break even, and they got it on 60. They're buying back shorts. You can see, though, some traders might have bought the close of 59, disappointed 60, get out around break even during 61. So it's hard to want to buy again above 61. 62, it's a double top, 1, pullback 2, pullback 3. So potentially a wedge top. And, we do end up getting more or less a measured move up of the wedge. We got a little bit higher. This is rare to get this big of a rally, I think. And generally when you get a midday reversal, the market has a lot of trouble getting far above the high. So I was surprised we rallied for as long and as strong as we did, but that can happen with a buy the close finish. So yeah, double top 62, and then you get 63 outside up bar. I wouldn't sell below 62. It's too small of a bar for me. And this is actually a perfect example of giving you more information at a better price. So 60, you don't have a lot of information about how the swing might look. And then you get disappointing follow through on 61. And so any of these traders who are trapped here, when we get back to their price, they're probably going to get out of break even. And so that's why it's not ideal to be selling below 61. I also think I haven't looked at this yet, but we'll see. I think that if you sold below 60 or the close of 60, or, let's use the low tick, for example, you should have a chance to get out of break even since it was probably a trading range. And if you sold essentially the close of this, you'd see their break even price is right at the low of 63. So if you sold the low tick here and sold more on a bear bar, some of those traders were able to get out during 63. You might try and buy above 63. It's hard to want to, it's still always in long, but this is getting kind of, becoming a channel, spike, channel. And so when you get spike, channel, it usually goes trading range, spike, channel, trading range. Instead, it went spike, channel, breakout today, which is unusual. And that was kind of why I was referencing that. 64, bad follow through. And so you get 65. Again, I think just spike, channel. 66, buyers below 65. No reason for bulls to get out until 69, in my opinion. You can see 68 or 67, by the way, probably buyers below 67 during 68. Why buyers below 67? Because there's a bull bar. Same reason there's buyers below 60, 65. It's a bull bar. And then you get 69. If 69 is bigger, if 69 is an outside down bar, I think it's a reasonable swing trade. Why? Because if I'm going to take a trade like this, where it's a bull channel, I want it to break out of something. And if you get an outside down bar, at least it's breaking out of the prior bars high and low. But you don't end up getting that. And so a lot of traders won't take the sell below 69. And you can see if you get bad follow through on 70, a lot of those traders exit around break even during 71. And that's what causes the rally. It's okay to buy above 71, I think, but it's hard to want to do with all this. It just looks like a trading range. And then you get follow through 72, 73, 74. And the thing about this buy the close rally, which sometimes happens, is none of the bars are quite, awesome. They're all just super okay. And when that happens, a lot of traders are trapped out and they're chasing the market up. And so they're not able to buy until later, and that can, cause the market to keep rallying. I want to, well, first off, I'm going to go over the daily chart, but I want to talk more about always in general when I'm doing these reviews. I just want to talk about it deeper because it's the most important concept in trading. So on the daily chart, we're pretty overbought in the short term, but this is definitely a strong enough rally for a second leg. So even if we test back down, we're probably going to get some sort of higher low. And then, so maybe we'll pull back, I don't know, maybe 50% of this and get some sort of rally from here that goes for a second leg up. Maybe we'll test this breakout point since there was an open gap here. Gaps will close in trading ranges. Maybe we'll test this low, that low, that low. There's a lot of magnets above. So it's not unreasonable to think that we're going to pull back and get a reversal up. But right now, you could argue it's buy the close for the bulls. So it's reasonable to be long on the daily chart, which is important to know the always in direction of the daily chart. The weekly chart is one other thing I wanted to go over. Like I was mentioning, bulls want this to be a second leg trap for the bears and, a breakout, essentially a breakout attempt after a pullback from what ended up being a wedge. And bears are hoping that this is strong enough for a second leg down. This is just a pullback. But the problem is limit order bulls who bought below here could buy more lower and make money. And I suspect that we're probably going to try and test the breakout of, this low. Probably not this week, but maybe next week. We'll try and get back to this low and see what's there. But I wanted to talk a little more about always in. Coming into the day, it's probably always in long after the gap. But it's hard. It's really hard to want to get long. And I think it's pretty, it's probably always in short on the close of 5 because it's a big bear bar closing near its low. What do bulls have to do here for you to want to buy? They need a really big bull bar or, some sort of reversal bar, which they did get a reversal bar, but it wasn't big. So probably always in short here, but that the downside is probably limited because it looks like it's going to end up forming a wedge. We get a double bottom. I don't think it quite goes to always in long here at any point, but I think always in short bears are going to exit above 12 and look to sell again below a strong bear bar closing near its low, which they never really got in here. You could argue it flipped to always in long briefly above 18, but that's one of the spots where I think bulls needed one more strong bull bar, and it ended up just being a vacuum test of the 4 low. But I think it's pretty clearly back to, always in bears will sell again below 21 and they get big follow through on 22. There's no real reason for always in bears to exit anywhere in here. I think if you're, when you see this, those traders will put a stop right here and then get an inside pattern after climax. So they'll probably keep it. But then we try to break out to the downside first. So a lot of those traders will probably, maybe move their stops back up since we didn't get a close below the prior low. How you handle trading in channels is you can move your stop to the prior extreme once you get a close at the new low. So for example, we came down here. We got a strong close below the low of the day. So traders move their stop here. We go more sideways. 27 does not close at a new extreme. We pull back. We get another close, 33, below the low of the day. So your stop can go above 29. We continue down. We get another close here below the low of the day. So your stop goes here. And then you probably have to exit up here. But I think that you exit above 42 anyways. But my overall point being, it's that's how I would manage those channels. Channels are hard to trade though. So where was I? Okay, so bears will sell below 21. They get follow through. There's not quite any reason to exit. If they do, they can sell again below bear bar closing near its low, like 30 or 33. But it's hard to want to sell when it looks like it's going to end up reversing. I think always in bears exit above 42 or 44. And so I think those are both reasonable swing buys. And that's not, get big bear surprise 46. Maybe it's always in short again, but nothing to sell below down here. It's really hard to pick a direction here because it's not always in long. It's clearly not always in long, which makes you want to believe it's always in short. But if it's always in short here, that one good bull bar can flip the direction of the market. And when you get the feeling that one good bull bar can flip the direction of the market when you're in a bear trend, or one good bear bar can flip the direction of the market when you're in some sort of bull trend, you're probably actually in a trading range. And that's why, when you feel like one good bull bar is going to flip the always in direction and you're in a market like this, that you're looking for that bull bar to buy for a swing because you're saying essentially, I think it's a trading range. And if it's a trading range, we should rally because we're far down and probably forming a trading range bottom. After the final flag, I think 53 makes the market always in long again, and it stays always in long for the rest of the day. Always in traders might try to exit below 60, but it never triggers. I think you could probably exit below 62 or a scalp below 62. So like somewhere down here, a 1-to-1. Basically your thesis there is that, well, this didn't trigger and this might, but if bears are able to make a 1-to-1 of their risk, then my premise is no longer valid. You could also probably just have a stop down here. If you exit below 62, you might have to go high again above 63. I think always in bulls exit below 69. Bears might sell, but you wanted a bigger outside bar. If you got a big outside bar here, I think it goes to always in short. They can buy again above 70 or 71 probably. And then we rally into the end of the day and it's clearly always in long. Tomorrow is interesting. I'm probably expecting a trading range. Like I was saying, you got the leg one pullback and you're probably going to get some sort of leg two, but I'm not overly eager to buy tomorrow morning. It's a rally, so this is tight enough for a second leg up for sure, but I'm being cautious because I'll use this as a better tool, but this whole thing might end up just forming a trading range. We'll probably get a little bit of a new extreme, but I think it's all just going to end up forming some big trading range. And, when we start to pull back, because like I said on the daily chart, we're a little overbought on the daily chart. If we start to pull back, I think that, these highs are going to be a magnet because there are trap traders there that are still there. So yeah,